Okay, so let's, one thing about the regressions, and I want to kind of nail this down before we leave, is, I mean, a few people during the break asked me about these two different risk-free rates that are floating around, right? One is the risk-free rate that I use to get the expected return. The other is the risk-free rate that I use to do my Jensen's alpha. So let me do the separation. When I do my expected return, I want my expected return for the future, right? So I want the risk-free rate as of right now, going forward. So that 6.57% is the risk-free rate as of November of 2013, and it's a forward-looking rate. When I do my Jensen's alpha, what's the question I'm asking? Over the last 5 years, was this stock a good investment? The risk-free rate I should therefore be using to answer that question will be the average risk-free rate over the 5 years of the regression. That's what the 4% is. It should be, I was very sloppy language. That's the average annualized monthly risk-free rate. It's an average annualized number that I average on, but it's very sloppy. So basically, it's the annualized rate of 4%, and because I'm using monthly returns, I divide by 12 to get a monthly rate.
Yeah. So my question: 4%, 6.5%, 5.7%. Is not a big difference in the number itself.
It is what it is. It is what it is. So what?
This whole
Do interest rates change over time?
Yeah.
Then that answers the question. It can be a big difference. It might be.
4% and 6.57% is a big change, right?
But it's not in your hands, right? Interest rates do what they do. So you can't say that's too big. I'm not going to. It is what it is. The interest rate over on average over the last 5 years. Now it depends. What's your definition of big?
I mean, like a difference, like
So, but why is 4 to 5 big?
Like same computation.
No, but I'm saying big is in your mind because you have a sense of what a normal change is. I'm saying let go. There is no normal. Interest rates sometimes move a lot, and if they move a lot, you got to reflect it.
So
yeah?
this logic is like you should have like same interest rate.
No, there's no logic there because in this case, this is the last 5 years. You can't go back and change the last 5 years. So 4% is what it was over the last 5 years. There's no logic to bring in, right? That's the actual risk-free rate. Now we're in November of 2013. The actual risk-free rate today, looking forward, is 6.57. There's no estimation judgment to make. This is a given. This is coming from outside. You got to take that number for what it is. Right then, so it might not have changed, it might have changed. In this case, it did change a lot. Yes?
If you are given 2 time periods, so which one will we take? Like,
what do you mean 2 time periods?
I just see 2 time periods on the top. So which
No. That's the starting and the ending point. There's no 2 time periods.
No, on our one it's...
On our one it's given 4 time periods. So then what do you...
Yours is always 2 years a weekly, right?
Yeah. This, if you see there's 2 time periods, so which is the range? Yeah.
No, it just gives you the starting and the ending point. So basically...
I had also.
No, it's always 2 years. So basically the starting point and the ending point are the only 2.
There's another 2 years. 2012 to 14 and 13 to 15.
There are 2 betas that I printed off for you. The beta can be only for 1 time period. So where is your second page?
No, it's just, it says 4 dates on the page.
4 dates is on the page.
I can't even read this without my reading glasses. So maybe during the break I'll get my reading glasses and take a look at it.
And that range, what have we given?
I'll tell you what it is. So forget about what's written. It is the 2 years ending January 1st of 2016. You know why? Because that's when I printed off all your pages, December 31st. So it's 2 years of weekly returns starting December 30th of 2013 through December 30th. So whatever it says, ignore it. It's 2 years of weekly returns that I use to get the beta for your company. And in fact, that's good that you brought this up because that is what I wanted to do as, when you get a chance later, preparing for tomorrow's quiz, is take your stock and do exactly what I did with Disney. Let's do the easy ones first while you're looking at your page. Let's skip the first question because that's a little involved. Okay? What proportion of the risk in your stock comes from the market? What's the number you're going to look at? So look at your beta page.
18%.
It's R squared, right? 80%, 30%, 90%, 85%, whatever it is for your company. 12%.
From where do we get the risk-free rate out of this?
You don't get it on this page. You get it from yesterday's page. You had a risk-free rate in whichever currency you did. Don't follow regression is not going to give you the risk-free rate because that's not its job, right? So take the pieces that you need from different parts and you've got to bring them all together. Right? What's a beta for your stock?
Yeah.
Look at the
One
raw beta, not the adjusted beta, the raw beta. If I ask you for a range, what are you going to look at? The standard error of the beta, and now comes some stat 101. You know what a 67% confidence interval is? Plus or minus one standard error. So basically you got a raw beta plus or minus one. What's a 95% confidence? Two standard errors. You didn't think you'd ever have to revisit stat again, right? It's all statistics. Okay. And the expected return is the risk-free rate in whatever currency you choose to do your analysis. So go back yesterday and look up the risk-free rate for your currency, plus the beta, the raw beta, times an equity risk premium for your company. That's going to come from that geographical mix for your company. Everything has its place. Right? The risk-free rate carries the burden of currency. The beta carries the burden of what business you're in. The equity risk premium reflects what countries you operate in. Each piece allows you to bring in a different aspect of the company. Yep.
You just refer to your table all the time for the equity risk premium.
If you want to, but you should get control, but it should be updated, right? So don't keep referring to January 2016 if it's 2018, right? So you can use it, you can build up your own. Again, as I said, there's no rocket science in what I do, right? So it's basically a base cream for the US plus this additional spread. So if you want to develop your own way of dealing with the equity risk premium, start doing it. But here, when I got here, should not be the answer. So let me dig a grave for regression betas. Because that's how we talked about, that's how I was taught betas, is run a regression. And here's why I will not use a regression beta. I'll tell you what I use instead, but first let me tell you why I don't want to use regression betas. First, they're backward looking. See what I mean by that? You get a beta for Disney, for Tata Motors, for whatever company. What did I do? I looked at the last 2 years, the last 5 years. You think, so what? What choice do you have? Well, maybe I don't have a choice, but I want a beta for the future, not a beta for the past. That's the first problem. Second, they're subject to manipulation. I will leave it at that. Remember what I said, you give me 30 minutes, you give me a Bloomberg terminal, I can deliver whatever beta I want. Third, they're noisy. I love that word noisy because it kind of covers a lot of sense. What does that mean? When I give you a number, even if I'm honest and I've estimated beta, it's still an estimate. The standard error tells you how much it has in range. It's been 25 years since I've used a regression beta in evaluation. As I said, I value about one company a week, so it's 25 times 52. It's a lot of companies where I've come to this fork in the road and I've said, no, now you're going down the regression beta. So I'm going to give you an alternative, a different way of thinking about betas that is much more intuitive. And to set this up, what I'm going to do is show you a page of betas. And with each of the companies in this page, I'm going to give you a beta and I'm going to give you a story about the company as to why I think it has the beta that it has. And along the way, maybe you can start thinking about what companies do that drives the beta. So let me start at the top. Bulgari. What does Bulgari do? Produce a lot of stuff that nobody needs at a really high price, right? I'd say the same thing about H. Stern. I mean, there's a whole set of, it's a luxury. Good producer, and it has a high beta. Why? Because nobody really, it's a really discretionary product. Trust me, you can live without a Bulgari. If you tell me you cannot, you have some serious spiritual problems. High beta because it's a discretion. So put that as one of the things. Is your product or service discretionary? The more discretionary it is, the higher beta. Quest Communications, telecom company. High betas. You know what telecom companies generally tend to have high betas? The basic business is not that risky, but what do they add to the business that makes their equity so risky? First is there's a fixed cost that they have. The second is they borrow money like crazy. I've never understood this about telecom companies. They borrow like crazy. You're saying, so what? When you borrow money, you increase your exposure to everything else, right? Basically, if you're exposed to interest rate risk, exposed to economic risk, by borrowing money, you make that exposure far greater. That's the second leg. High beta because you have lots of debt. Then you get to Microsoft, beta 1.25. I've actually tracked Microsoft's beta every year since 1986. Here are their IPO. When I first started looking at Microsoft, its beta was 2. It's drifted down over time. Why? As the company's gotten larger, it has become more diversified in terms of its customer base. And the product might not have, but more people in different areas use it. And as you do that, your beta is going to start drifting down towards 1. GE, beta 1.15. What business is GE in? Actually, the question I should ask is, what businesses is GE not in? Because that's probably easier than the beta. Because it's in 26 different businesses. So let me ask you a question. This is your classic conglomerate, right? What should happen to the beta of a company as it becomes a conglomerate? It should move towards 1. The only reason GE's beta stays above 1 is the single largest piece of GE is GE Capital. You think, so what? And what does GE Capital bring with it? It brings $150 billion of debt into the picture. See what that's going to do, right? Tax as a ballast, pushing up the beta above 1. In fact, that's going to be the next phase of GE as GE Capital gets spun off. It's actually, you're seeing the unraveling of GE, and it cannot come a moment too soon. Then you get ExxonMobil. Risky company, right? Especially right now, when you think about oil company, you think about risk, but the risk you're thinking about is oil price risk. And right now, oil price risk is actually cutting in the same direction as all other risk. As oil prices drop, everybody else is imploding, but usually the relationship is a little more subtle, right? Oil prices drop, it's true, oil companies do worse, but airlines tend to do better. So historically, oil price risk might be high, but it's generally been not that highly correlated with the rest of which means you can be a commodity company, and historically your betas have been lower than the market because most of your risk comes from a risk that is not cutting in the same direction as everybody else. Which brings me to Altria. Used to be called Philip Morris. You know, I told you yesterday about different parts of the world and where you're earning higher returns and lower. I said China's 3.5% below. I also looked at different businesses to see which businesses were earning well above their required return and which ones were not. You know the most profitable, the business that generates the highest excess returns is? It's tobacco. 22% more than your cost of capital. It's huge excess returns. Risky business? Why not? Exactly. If you want to make your beta low number, make your product or service an addiction and don't pick on tobacco. If you could addict your customers to your products, would you do it in a minute? Yeah, absolutely. We all try, it just worked for them.
What about the risks from making
the risk? That's exactly. And the risk in a tobacco company is litigation. Why isn't it showing up in the beta? Because it's like that biotechnology. See, beta was exactly. Beta was never designed to carry that risk. Which brings me to my very last company there, and here's a puzzle, and this is actually a great question to ask in an interview. It's Harmony Gold Mining. It says the beta is negative. That's almost mind-boggling. Let's think about this. If your beta is negative, when I plug it into the equation, risk-free rate plus beta times expected risk premium, what's the expected return on Harmony Gold Mining going to be? It's going to be less than the risk-free rate. You think, that is absurd. Why would I invest in a stock if I'm going to make less than the risk-free rate? You know what a negative beta is? It basically is insurance. Against what? Some big macroeconomic risk, and historically, what's gold been insurance against? Inflation primarily. So if the bulk of your assets are tied up in financial assets and you buy a gold mining stock, you're buying insurance. And if you buy insurance, what do I make you do? Pay. And how do I make you pay? I make you accept less than the risk-free rate because now do you see why it's so dangerous to be a gold bug? You know what gold bug is? These are people who think that gold is where all your money should be. There's a lot of people out there. And they complain, they whine all the time. They whine about how unfair the world is. And you know why the world looks unfair to them? Over the last 30 years, if you invested in gold and gold mining stocks, you'd have made about a 3% return a year. That is so unfair. If you put all your money in gold. But if you think about gold as being this insurance, that's exactly what you should expect. Over long periods, gold and gold mining stocks should have low returns because they act as safety. I mean, they're like, buffers for your portfolio with primarily financial assets. So what I'm going to do is use this page to kind of launch into a discussion of the fundamentals that drive betas. So you look at a company. So what kind of beta would I expect this company to do? Don't look at a regression. So think of whatever company you want, including the company in front of you or whatever other company, maybe the company you work for. Here's the first question I'm going to ask you to try to figure out what kind of beta to do. I'm going to ask you how discretionary, because think about it, beta measures how you move with the market, with the economy, right? In the old days, the dividing line I used to use is if you're a cyclical company, you should have a higher beta than if you're a non-cyclical company. What's a cyclical company? Housing, steel should have higher, autos should have higher betas than food processing. But I have a different question to ask. So how discretionary is your company's products and services? You know what I mean by discretionary? Your customers can live without your product. They can delay buying it. They can defer buying it. You'll have a much higher beta than if they cannot do that. So I'm going to give you two very simple exercises that I think will allow you to understand betas a lot better. In the first one, I want you to put yourself at the kitchen table of the average family as they're making up their budget for this month. Ready? You're sitting at the kitchen table. Across the table is a family. And they're starting to list the items they're going to buy, starting with necessities working down. You ready? What's on top of the list? Food.
What's that?
Beer. No. Shelter. Diapers. It's kind of nasty to want to have babies wandering around not. And then as you work down the list, you start adding items you will buy if you have the money, right? A vacation in the Caribbean, my own island in the Caribbean, a Ferrari Testarossa. You know you'll never get down that far in the list, but it's so much fun making the list. You ready? Let's put the list in front of us. Here's what I want you to do. I'm going to name some companies, and based on this list, tell me whether you'd expect them to have low betas or high betas. A grocery store chain, Safeway, Kroger, whatever. Low beta. And because it's okay. Whole Foods.
Higher.
Have you ever been in a Whole Foods?
Higher.
Whole Foods, basically, the eggplant costs you 4 times as much, but it's organic. When things are good, you're okay, you're organic. When things are not so good, you say, well, I'm going to die anyway. So what does it matter if the eggplant is contaminated? So within the grocery business, you'd expect a traditional grocery store to have a low beta and Whole Foods to have a high beta. The New York Times. Or any newspaper that you're familiar with. What are the two revenue sources?
Advertising.
One is advertising, the other is subscription. Subscription revenues are very sticky. Why? Because canceling your New York Times subscription sends a wrong signal to your neighbors. So you've lost your job, you really can't afford the paper, but you still keep getting it delivered because you're afraid that if that paper doesn't land on your front lawn, that people are going to say, this guy's lost his job, he's in trouble, so you don't want that. So subscription revenue, but advertising revenue, you can tell how well the economy is doing when you pick up the Wall Street Journal and the New York Times. If you have trouble picking it up, the economy is doing really well because it's like 50 pages, 500 pages. If you pick it up and say, did I pick up the paper already? Oh, it's already in my hand. The economy is doing badly. So New York Times, high beta. Coca-Cola. You got to get really desperate to go down the generic cola aisle at the grocery store, right? Brand name plus low price converge, pretty low beta. It's a remarkably powerful device for thinking about betas. So I was doing a Ferrari IPO valuation. This is actually a very interesting valuation. You know how many cars Ferrari sold last year? Make a guess. 7,255 cars during the whole year. 7,255. That's how many cars Volkswagen rejects in a day probably on its assembly line. So it's a small company. That makes a remarkably impractical vehicle. There's one guy in my town who owns a Ferrari. What the hell are you going to do with this? Drive it to the grocery store? No, you can't park the car and get out of the car. Drive carpool? You got one extra seat. How many kids can you load up here? You know what he does? Only in the summer, once every week, he pulls the car out of his garage, he drives it around town, and he puts it back into the garage. Then he double locks it. He's got a security system on that garage that's 5 times more secure than what he has on his entire house.
What's wrong with that?
Young Ferrari does. But this is my point. 7,255 cars in practical vehicles. So why are we paying $1.5 million for that car?
Well, John can answer.
Young Ferrari? Because it is an exclusive club. Let's face it. If they sold 725,000 cars a year, you wouldn't feel that special. So when I valued Ferrari, I actually valued it as an exclusive club. And I made an assumption, and John can tell me whether this assumption is reasonable or not, that the kind of people who buy Ferraris don't even notice what the economy is doing. I was in the Middle East. 13% of all Ferraris get sold in the Middle East. To people, oil prices went up, what's 3 billion instead of 5 billion? Who's going to notice? So you know what? I ended up using a low beta and a low cost of capital if they stay in their existing path. And in fact, I revalued them using the Maserati model. Those of you familiar with Maserati, they introduced the Ghibli, which was their low-priced. So don't think it's like it's like $100,000 still, but it's low price. And it actually doubled their sales. But that doubled sales has actually gone with a much higher beta and because now you're attracting people who are reaching. So I'm going to give you a second exercise for you to think about. And try this out. In fact, don't try it this weekend because it's supposed to snow. And you're all going home right after this weekend. So it's too late anyway. So you couldn't have done this. Maybe you should do it this evening. Here's what I'd like you to do. Walk out onto Broadway. Whichever direction. Broadway is that way, I guess. Go to 8th Street and take the N or the R subway uptown. Get off at 60th and 5th. Okay? Come out of the subway because I'm going to be very specific about my instructions. And here's what I want you to do. I want you to walk down 5th Avenue. And as you walk down 5th Avenue, I'd like you to stop in front of every business you pass and very loudly ask the question, if that business were traded, what kind of beta would I expect it to have? You think, why loudly? People will think you're crazy. This is a good thing. Tourists will cross the street to avoid you because they think you're crazy. You have the entire sidewalk for yourself. You ready? Let's go for a virtual walk. Down 5th Avenue. You've done the stretch of 5th, right? Even if you're not a New Yorker. So 60th, walking downtown on 5th Avenue. What's to your left as you walk by? What's the first store you pass? Apple. Don't stop and ask. For me, nothing in that store is ever discretionary. So if I were setting betas, I have a really low beta. But let's pass it through. I'm too biased to make that judgment. You cross 59th, and you're in what I call the Italian-French section of town. Gucci, Ferragamo, high beta, high beta, high beta, high beta, high beta. Then you get to 54th, and you pass St. Patrick's. The cathedral. Don't ask high beta or low beta, lightning might strike you down. You don't mess with some things, right? And then you get past Rockefeller Center, the betas start to fade a little bit. You get these Dwayne Reeds popping up, it's almost like they're trying to get you zigzag to avoid them. Then you get to the New York Public Library on 42nd Street. Betas used to hit rock bottom. It's improved a lot in the last 25 years that I've been in New York. But I remember you passed 42nd Street on 5th Avenue. You were in the stretch of stores with a brown paper in the windows, a shady looking character in the doorway saying, come on in, cheap, cheap. Cheap what? Just come on in. You see tourists going in, not coming out. I know what kind of risk that is. But if you made it through that gauntlet all the way down to 34th, and this is still true. If it started raining, there was a guy who sells umbrellas on 34th and 5th. Only when it rains. I don't know where the guy pops up from. I think he comes out of the ground. Umbrellas for sale. Crappy little pieces. They just fall apart. But let's face it, you have a laptop on your back. You have 3 blocks to the subway stop. This is as non-discretionary a purchase as you're going to get. If that guy ever figured out a way to incorporate and trade, he'd have a really low beta. We make betas more complex than we have to. When you set your pathways to what your beta is by the business choices you make. So if you produce and sell luxury items, I would expect you, unless you're like Ferrari and it's super, super, super exclusive, for your beta to be high. And so among retail stores, I'd expect luxury retailers to have higher betas than department stores, which should have higher betas than discount retailers. It's the nature of the process. So that's the first stop. Tell me what to do. Second stop. Tell me something about your cost structure. The greater the proportion of your costs that are fixed costs, the higher your beta will be. Think of what? When you have a lot of fixed costs, in good times you make lots of money. In bad times, it's like being a manic depressive. You're never in a good mood. You're in a great mood. You're never in a bad mood. You're at the end of the world. It's done. That's what fixed costs do. They magnify everything. I'll give you an example of a sector with high fixed costs. Airlines. What's a typical cost structure for an airline? Biggest single expense is usually leasing the aircraft. Fixed cost or variable cost? Fixed. You can't go to GE Capital and say, you know what guys, the plane's only half full, I'll pay you half the lease. It doesn't work that way. Fuel costs. Fixed cost or variable cost? Once you've set your schedule, they become pretty fixed, right? Can you imagine getting on a plane, the pilot comes out and starts counting. 1, 2, 3, 4. Only 5 people on the plane, fill it up halfway, let's see how far we get. So I know your weight, the weight you carried, but it's at the moment you're flying New York to LA, you better have 80%, 85% of fuel you have to start off with, pretty much fixed costs. If you're a unionized airline, your employees are fixed costs. I've been on flights where I've been outnumbered by the stewardesses. It doesn't help service one bit. No. It might do the opposite actually, fixed costs. So for airlines, it's always feast or famine. Have you ever noticed the airlines having a normal year? I haven't. They're either making billions or they're going bankrupt. You're saying, what the heck? Make up your mind. But that's the nature of fixed costs. Everything gets magnified. And in fact, if you look at a company, one very simplistic way of measuring fixed costs, because when you look at a typical income statement, accountants don't break expenses down to fixed costs and variable costs. You've got to make judgment calls. So I'm going to give you a trick you can use to back out how much a company has in fixed costs. And it goes to an insight we said before. We say if a lot of fixed costs, what happens? Small changes in revenues will translate into big changes in operating income because everything will flow down. So what I do to compute fixed costs, or the operating leverage of a company, which is basically the same thing, is I look across time, in this case Disney, at revenues and operating income. Over this entire time period, revenues increased by 11.79% a year. Operating income increased by 11.91% a year. So basically, I'm just taking the percentage change each year in revenues and operating income. Then I'm going to divide this number by this number. You say, what the heck are you doing? Basically, I'm trying to see for every 1% change in revenues, how much does operating income change? Because the higher that number, the more fixed costs I have. In the case of Disney, that number is 1.01 if I look at the entire time period. But remember what I said they did in 96. They changed their business by buying cap cities. So post 96, that number is 1.25. And I make a confession. After I got the 1.25, I looked and said, well, is that a high number, a low number? And what my reaction was, I have no idea. So I computed that for all entertainment companies. See where I'm going to go next? The average across entertainment companies for that number is 1.35. Disney is at only 1.25. To the extent that I trust this number, there's a lot of noise even in this number, I'm saying that Disney has less fixed costs or more fixed costs? Less fixed costs, which means its beta should be lower. Here I'm not going to go that far, it's too small a difference. I'll tell you when this makes an issue. I talked about the airline business being a high fixed cost business. For 35 years in the US, there's been an exception in that business. An exception about whom more cases have been written. And now there are all these imitators all over Europe. It's Southwest. And if you look at any strategy book, they'll talk about all this neat stuff that Southwest does. I'll give you my financial twist on why I think Southwest is different from other airlines. First, it does lease its aircraft like every other airline. But for a very long time, for almost most of its existence, if you took a Southwest flight, it was always on a Boeing 737. Every single aircraft they had was a 737. You know why? Because each aircraft is unique enough that it needs its own maintenance crew. Early in the process, said we're going to have one maintenance crew because it reduces our fixed costs. Fuel costs, I hope they don't economize because I do fly Southwest once in a while. But they're one of 2 airlines in the world that consistently hedges. The other is Singapore Air. You know what I mean? They hedge against all. As opposed to what? As opposed to most other airlines which hedge at exactly the wrong times. They start hedging when oil prices hit 120. They stop hedging. It's almost like all you need to do to figure out what oil prices are going to do is look at what airline companies are doing the exact opposite. They're amazingly contrarian. That's another thing about hedging, is if you're going to do it, just do it all the time. Don't play stupid mind games. You're not a Jedi. Okay? Maybe you want to be a Jedi. You can't forecast these things, just let it go. So fuel costs, they hedge. Employee expenses, Southwest is unionized, which surprised a lot of people, but it's the only airline where a stewardess has checked me on to a flight. Has that ever happened to you on United or Lufthansa? Stewardesses can hang around, no, that's not my job. They check the job description. I've worked at 35 years. I've never checked anybody on before. I'm not going to start with you. Southwest, people, there's enough flexibility that people do, which reduces their fixed costs again. They don't have to have that 100 extra staff. But here's the biggest saving. For the longest time, if you flew Southwest out of the New York area, you know which airport you flew out of? I'll tell you which airports it was not. It was not JFK, it was not LaGuardia, it was not Newark. I remember my first Southwest flight out of the New York area. The day of the flight comes by, I didn't even bother checking it. It was New York Airport. I looked down, and it said islip. I'll make a confession, and I don't mean to insult anybody who grew up in islip. I had no idea what islip was. It turns out to be this small town in Long Island, and I was flying out of there. Can you imagine getting into a cab and saying, take me to islip? I said, what? Where is that? And then it was a New York LA flight, so I leave from islip. I'll find a way to get there. And I land in LA, and I thought it was LA. I come out, and there's a huge statue of John Wayne in the airport. I said, this isn't LAX. You know where I landed? Orange County's airport has this huge, it's a great airport to land in, to be quite honest. But I flew islip to Anaheim. And this was a pattern that Southwest set around the country. They flew out of one no-name airport to another. You say, why? Have you ever flown United out of Newark? I have to all the time because I live close by. You fly out of Terminal C. You know how many gates United has? Like 200 gates. I think they do it for laughs. They fly you to gate 3, give you a connecting flight in 125, and they see whether you make it. There's a guy upstairs, I'm sure, watching you on TV. They'll never make it. Let's switch the signs on them. Like rats in the maze you run around. And United controls every single one of those gates. You know how it controls it? It pays Newark Airport a fixed fee. That's how British Airways controls all those Heathrow gates as well. You pay that fixed fee whether one flight leaves out of the gate or 100 flights leave. It's a fixed cost. And for much of its existence, Southwest said, we're not playing that game. We're not paying some airport huge fixed cost, because Southwest gets to do this for free out of Iceland. In fact, European budget airlines are doing the same thing. I remember taking a European budget airline, landing in what I thought was Paris. It was like 120 miles, and they said, where is Paris? 120 miles that way. So what do? Start walking. You get there sooner or later. This is, but it's the Southwest model being played out. Lower fixed costs. But there's a trade-off. By doing this, Southwest did lose some customers, right? There are people who said, I will not fly out of Iceland. And they said, that's okay. We'll give up revenues in return for more stable earnings. And over time it showed up. Every time you have a crisis, the other airlines go under very quickly. Southwest manages to hang in there. So that's the fixed cost issue. That's the second step. For whatever reason, Microsoft, when I go from my Mac version to my PC version, seems to lose all my symbols. So wherever it says question mark is really a beta. So it should be okay in your notes, but no, it doesn't seem. So now comes the third piece of the puzzle. What business are you in? How much are your fixed costs? Third question I want to ask you is how much have you borrowed? And think of why it matters. When you borrow money, you create a fixed cost you did not have until you borrowed the money, right? Which is interest expenses. You got to make those in good times, which is not a problem. But you also have to make them in bad times. The banker seems to be not very forgiving of this. Which essentially means you can take a safe business and make your equity really risky by borrowing enough money. And here I can actually be specific about how much your beta will move as you borrow. And I'm going to draw on an equation that just comes from the basic algebra of weighted averages that allows me to link the beta of your stock to how much you borrow. It's called a levered beta. Up to now we've talked about beta as one concept. Now I'm going to divide up betas into levered and non-levered betas, and I'll give you the intuition as we go along. The levered beta is the beta that you will observe for your stock. So think of that as the left-hand side of the equation. What's it going to be driven by? It's going to be driven by the beta of the business you're in, that's the unlevered beta, scaled up by how much additional risk you've created with borrowing. So I'm going to capture how much you borrow with a debt to equity ratio. So as you borrow more, the debt to equity ratio will rise. You're saying, what the heck is that 1 minus t doing in there? I told you debt creates a fixed cost, right? That's a pain in the neck. But it does come with a slight bonus, which is
Taxation.
you get a tax saving. That's what the 1 minus t. Unless you're in Saudi Arabia or much of the Middle East, where don't do that because you don't get a tax benefit. But at least in parts of the world where interest is tax deductible, it's almost like the government puts its hand over your shoulder saying, you know what, borrow money, but we'll be on the side, on your side. So the levered beta for a stock is a function of both the riskiness of the business you're in and how much you borrowed. Let me ask you a question. When we ran the regression beta for Disney and we came up with a beta of 1.25, remember that Bloomberg beta page?
Yeah.
Was that a levered beta or a non-levered beta? You guys are very quick to say levered. Where did the leverage come in? I never looked at the debt, right? I just ran regression, the return. So if it's levered, tell me how it managed to creep in there. You're right, it is levered. But how did it get levered? What? Because the stock returns are used to reflect the fact. So if you're highly levered, your stock returns are going to be more volatile. But let me ask you a follow-up question. What's the leverage that's embedded in that beta? The debt to equity ratio you see now, or the debt to equity ratio you had over the 5 years of the regression? Now you see why. Another reason why you have to be wary about regression betas. Because if you're a company that's paid off all your debt in the last month, your regression beta will still reflect what you used to owe. If you borrowed a ton of money in the last month, there is zero chance it can reflect it because it's looking at the last 5 years. So I'm going to give you a very simple trick that you can use to clean up at least for that factor. We go back. The 1.25 was my regression beta, right? That came from the Bloomberg page. During the period of the regression, the average debt to equity ratio Disney had was 19.44%. So I have the beta. I know what the debt to equity ratio was during the period. The tax rate that Disney faced during this period was 36.1. And I'll come back and talk about what exactly the tax rate measures. So I have three numbers. I have the regression beta, the debt to equity, I have the tax rate. So here's what I'm going to do. It's going to sound weird. I'm going to take out the debt effect from my beta. It's called unlevering a beta. So I'll start with the regression beta, which is a levered beta. Divide by 1 plus 1 minus the tax rate times the average debt to equity ratio. I come up with an unlevered beta of 1.11. We use words like this in finance all the time. Unlevered, levered. But it's like a foreign language to people who are not involved in the process. You know, what the heck does that even mean? So give me an intuitive way of explaining to somebody who's not inside our echo chamber what exactly the 1.11 measures and why it's different from the 1.25. Yep.
It measures the Disney, a fictional Disney that had used no leverage.
That's one way to think about this, because it's a choice, right? Disney could have been an all equity funded company. So if you'd ask me, what would Disney's beta have been if they'd been all equity funded? The answer is, beta would be 1.11. Why did it get to 1.25? Because they chose to use debt. Debt is a choice. You think, but I'm in a business where everybody borrows. Hey, you don't have to borrow. You're not a 6-year-old. Just because everybody does it doesn't mean you have to do it. This is the excuse you're hearing from commodity companies now that are in trouble, right? We borrowed why everybody was doing it. That's not a good enough excuse. The unlevered beta measures the beta that Disney would have had if it were an all equity funded company. It also is a measure of the riskiness of Disney's business. As opposed to what? As opposed to its equity. In fact, let's separate the two. Can you have a safe business with very risky equity? What do you have to do to make a safe business have risky equity? Borrow like crazy. Real estate, fundamentally, is a very safe business. The value of real estate, even though it changes, if you look at it in comparison to other asset values, is not big. You know what makes real estate risky? Is for centuries, real estate has been leverage driven.
20 to 1 debt ratios, 25 to 1, 30 to 1. And then we wonder why we have booms and busts in real estate. We have booms and busts because we lever up this business like crazy. You borrow money, it's a double-edged sword, right? The good news is you get this tax advantage, makes your equity kind of play more, but it does come with this additional risk you got to factor in. I'm not saying don't borrow money, but I'm saying do it with open eyes. It will make your returns on equity much higher on average because you have less equity to put in play, but it will also make your cost of equity much higher because you made the equity more risky in your business. So I'm going to do a little what if. Disney's debt to equity ratio in the last 5 years was 19.44%. Its current debt to equity ratio is about 35. Let's say I'm the CFO of Disney and come to you and say, look, you know what? I want to borrow more money at Disney. We have all these plans to build this new Star Wars theme park. We need to borrow money. We want to get to a 50% debt to equity or 100% debt to equity or 150% debt to equity or maybe do a leverage buyout of Disney as a company. Bob Iger wants to buy the whole company and make it a private company. The typical leverage buyout, the debt to equity ratio after the LBO is about 10 to 1 for every dollar of equity. This table actually should allow you to estimate the beta for Disney at any debt to equity ratio. What I do is I start with the 1.11, which is the base unlevered beta. You tell me how much you want to borrow, I'll tell you what the beta is going to look like. With a leverage buyout, you know what the beta will look like after the leverage buyout? Let's think through that. If you have a beta of 7.5, remember the equation we had risk-free? So your cost of equity is going to be what? 45, 50%, right? You see, that's absurd. That's what happens when you have a small slice of a very highly levered firm. So next time you look at the returns that a KKR or Blackstone make, don't get too impressed too fast. Because they will look, hey, I mean, 30% return. Looks impressive until you realize they're levered up like crazy. It's a different game when you play a highly levered game, and you have to bring in the effects of leverage into the equation. Yes?
Well, what's the effect of the relief of taxation? Shouldn't this help the ultimate return to the equity holder?
I'll tell you what, the relief from taxation actually makes your return to equity investor higher. And here's why. If you'd actually made an all-equity funded company, all your cash flows would have had to come out of after-tax income, right? So if you pay dividends, you buy back stock, everything has to come out of after-tax income. When you borrow money, interest expenses, in a sense, saves you taxes because the government allows you to set that off against income. So it's like a subsidy you're getting from the taxpayer. We can ask, why is there such a subsidy? That's a different question. But around much of the world, governments spend. It's actually funny because what do politicians tell you about companies borrowing money? They say, we hated the companies borrow money. They borrow so much money. And while they're complaining, the question you got to ask them is, who wrote the damn tax law? You guys did. And what do? You've tilted the tax law towards debt, and companies are doing exactly what you'd expect them to do. Because when I borrow money, you're giving me a tax benefit I could not have used if I'd been an equity investor. That's what's going to drive. Tomorrow when we talk about the right mix of debt and equity, this is going to be one of the things that drives you to borrow more money. So here's what I'm going to do. Yes?
How is this compared to private company?
Same process. You take a private company, lever up, it'll get even riskier. But what you lever up, and this is what makes it even scarier, here I levered up only the market portion of the risk. If you're a private business, you're exposed to all risk and you lever up, you can end up with a beta of 25, 30, 35 for the same company because you're building up a much bigger base. So what I'm actually going to offer you is an alternative to a regression beta. It's the way I think about betas. You're welcome to use it, you're welcome not to use it. I really don't care. It goes back to that property I said betas have. They're weighted averages. What does that mean? You give me a mutual fund, say, what's the beta of the mutual fund? It's a weighted average of the stocks in the fund. But I'm going to use it in a different way. What did I say GE was in? 26 different businesses, right? What if I could give you the beta of each business there? You say, how are you going to come? Leave that to me. If I could come up with the beta for each of the 26 businesses, what should the beta for GE as a company be? A weighted average of the 26 businesses. Question?
More fundamental question.
Yeah.
It's all about expected return on the equity. So if you're going to Like we.
It's not all about. That's actually the less interesting part, right? It's all about the return you deliver on the equity relative to the expected return. Because expected return is just what you need to make, right? So when you lever up, you push up your. So the question is, are you making enough as a return to kind of overwhelm? Yeah.
So why don't we play that in risk premium itself? Why do we play that in beta?
Because risk premium is the price. No, you can't count in both places. Risk premium is the price per unit of risk. And if I change the risk premium, it's company specific. Right now, the risk premium that I have has nothing to do with the company. It basically comes from the outside. So what I'm doing is I'm separating the part of the model that's outside my control from the part that is in. So here's what I'm going to do. I'm going to try to estimate a beta for Disney by looking at the business itself. And as I do this, I'm going to talk a little bit about the kind of hurdles I ran into trying to build up. I call this a bottom-up beta. And here's what I'm going to do. I'm going to start off by looking at what business you're in as a company. So let's play a game. Let's suppose you tell me you're in two businesses, steel and chemicals. And you say, I want a beta for my company. Here's what I'm going to do. I'm going to go back and find as many publicly traded steel companies as I can and as many publicly traded chemical companies as I can. I'll give you in a minute why I need publicly traded. So I find 100 steel companies and 100 chemical companies. Because they're publicly traded, what can I look up for each company? I can look debt to equity and also regression beta for each company. I know they're crappy numbers. I've already admitted that. So I have 100 crappy regression betas for steel companies, 100 crappy regression betas for chemical companies. I'm going to average them out. What's the average of 100 crappy numbers going to look like? This is the magic of the law of large numbers. The magic of the law of large numbers, you average 100 crappy numbers, you know what you get? A precise number. You're saying, how the hell does that happen? It's actually fairly intuitive. When you say a number is crappy, you're saying it's either too high or too... That's what the standard error is, right? Sometimes you're overshooting, sometimes you're undershooting. So when you average out, what happens? You average out your mistakes. So that average of 100 steel company betas is actually much more precise than any individual steel company. And because I have the debt to equity ratio for these companies, I can do what I did for Disney and take out the effective debt from those companies. And what I end up with is an unlevered beta for steel companies. And I do the same thing for chemical companies, an unlevered beta for chemical companies. Then I come back to you and say, you told me you were in two businesses, steel and chemicals. I now have a beta for each business. How much value do you get from each business? You know what you're going to tell me? I don't know what value I get, but I can tell you how much revenues I get. So good. That's a good starting point. You get 70% from steel, 30% from chemicals. I take a weighted average. I end up with an unlevered beta for your company. Then I ask you a final question. How much debt do you have? You can say, I don't borrow money, which makes my life very easy. I just use the unlevered beta. Or you can say, I have a 30% debt to equity ratio. I plug that in. I end up with a levered beta for your company. Think of what I'm doing. I'm doing this because I don't like regression betas, but I'm still using regression betas. But the averaging is what reduces the standard error. I'm getting a more precise beta because I'm averaging out across all these companies. And here's the other bonus. Let's say you entered the chemical business yesterday. There is zero chance regression beta could reflect that, right? But if I'm doing this bottom-up beta, not only can I reflect where you're in right now, but if you tell me you're going to be in the technology business tomorrow, I can say, okay, that's easy. I'll bring in the technology business. I'll come up with a weighted average. I gain control of the beta process when I do a bottom-up beta. Are there problems you're going to run into in the way? Absolutely. In fact, what I'm going to do is I'm going to take Disney and I'm going to come up with the bottom-up beta. Disney is in 5 businesses. It's in the media networks business. That's a broadcasting business. That includes ABC, ABC Family, Disney Cable, and of course the giant in the room, which is ESPN. They're all in media network. In fact, Disney also owns an Indian TV company. I forget, NDTV, something like that. That's also in there. Parks and resorts. You can help me out here. What's in there? Disneyland, Disney World. Euro Disney and Tokyo Disney, actually, they have management contracts. It's a different kind of setup, but it's in there. They also, Hong Kong had not, in 2013 was just coming into play. Today it will include Hong Kong, and 5 years from now it will include Shanghai. Right? But it also includes the cruise lines. You say, why is it in there? Because would you take a cruise and pay a 50% premium if Mickey were not on board? I mean, that's the reason you pay to take the Disney cruise. It's not because you're going to some part of the world you could never have gone to, because your kid wants to see Mickey. It is an extension of the theme park experience. So they put into theme parks. You might agree with them or disagree, but that's where it is. Then you have the movie business. What's in here? Of course, you have Disney animated. Marvel. Star Wars actually is part of the Disney Studios. Pixar. It used to include Miramax, but now it's kind of condensed. But there are 4 basic franchises. They're all in the movie business. Consumer products. You know what's in there? Everything that can't fit anywhere else. They throw that in there. Because much of Disney's stuff now is licensing. They don't produce their own toys anymore. There used to be a big Disney retail business. They used to have, there are now like a few Disney stores left. They're more like flagship stores, but they pulled out of that business. And finally, there's interactive. You know what's in there? The gaming, their apps. It's the smallest, the newest business. So those are the 5 businesses. And Disney breaks down revenues by business. Disney's actually pretty good. They break down not just revenues, but a whole bunch of other data. Some more reliable than others by business. So that's my starting point. I got it right out of the annual report at 10K. What do I have to do now? Is to come up with a beta for each of these 5 businesses, right? So I'm going to take you through the process of how I tried to do this and what kind of roadblocks I ran into with each one. Let's start with the broadcasting business. When you think about big broadcasting companies in the US, here's what you tend to think about. ABC, CBS, NBC, and Fox. And here's the problem I ran into. In 2013, ABC was owned by Disney. NBC was owned by Comcast. CBS was a standalone company. And Fox is owned by News Corp, and God only knows where it is in News Corp. It's just hidden under layers and layers of stuff. In other words, I don't have very many companies because remember, you need 100 companies. There aren't 100 broadcasts. So I got desperate. And I get desperate all the time when I do these bottom-up betas. So I tried my first ploy when I get desperate. I've started moving up and down the food chain. Let me explain. The broadcasting business is companies that feed into it and companies that feed out of it. I started looking for those companies. And I'll give you a couple of examples. One is a company called Kingwood. Have you heard of this company? It's a company that syndicates TV shows. The Oprah show, the Jeopardy, for instance, the TV show. What they do is they package the show and they sell it to broadcasters. They do well when broadcasting companies do well, and badly when broadcasters. So that's one of the companies I looked at. The other company I looked at was Nielsen. You know what Nielsen does, right? They come TV ratings. Again, what I'm trying to do is find other companies that do well when broadcasting companies do well. And why am I doing this? Because the law of large numbers to work, what do I need? Large numbers, right? So I'm trying to push up my sample size. I ended up with about 26 companies in the broadcasting business. And I'm going to use them to come up with the beta. But let me take you through, I'll come back to that. But for theme parks and resorts, I went looking again for publicly traded companies. In the US, I found one, actually 2. One is a company called Six Flags, which is a disaster waiting to happen any moment. The other is this Midwestern company, Cedar Point something, which is, they have these 3, sample of 2. We gained desperation time. Here, what I did was I went global. Not postal, but global. What does that mean? I said, why am I just looking at US companies? Why not look at European theme parks? Like the Lego, Hey, you're saying, but you can't do that. It's a US company. What's the average beta across all US companies? 1. What's the average beta across all Brazilian companies? 1. The nice thing about beta is it's scaled around 1. I have no qualms about going global. And the reason I need to be able to do that is if you ask me to analyze Embraer, and I look for other Brazilian aerospace companies, you know what I'm going to find, right? 1, Embraer. And I'm replacing Embraer with Embraer. It does nothing for me. So we have to start to go global in these bottom-up betas. And with 41,889 companies, I don't care what business you're in, I can find companies for you that are in your business. End up with 20. Movie business, I had enough in the US, I was able to find 10. And in fact, let me take you through how I'm going to use these companies, taking the movie business as my example, to kind of illustrate the mechanics. So I went and found these 10 US movie companies, all publicly traded. There's my list. I looked up the regression beta. That's a levered beta. I also looked up the market value of equity, the debt, and so basically I'm looking up numbers that you can find for any publicly traded company. So equity, debt, and cash. And here's what I'm going to do. I'm first going to look at the average across my betas. I come up with a 1.35 across the deck. But the problem with averages, and we all know this, is especially with samples of 10, 15, all you need is one outlier to do strange things to your average, right? So in statistics classes, you're told if you have a smaller sample and you're worried about outliers, look at the median. So I also looked at the median. So the average beta is 1.35. The median beta across movie companies is 1.24. That's a good starting point. That's the beta of a movie company. But that beta includes two effects. One is the debt that these companies have taken on. The other effect, and this is a more subtle effect, is how much cash they've accumulated. You're saying, why does that matter? The beta of cash is close to zero. So when I look at a company like Apple, I'm getting a beta for the company, but Apple is about 1/4 cash and 3/4 smartphones, computers, etc. So what I want is a beta for just the movie business. So the first thing I did was I took the 1.24, which is an average levered beta, and I used the median debt to equity because if you look at the average debt to equity, it's 129.33%. Sounds astounding high, but the reason it's 129 is this Odyssey Pictures has a 550. It's a basket case, again, waiting to go under. So I use the median debt to equity ratio of 27%. So here's what I'm going to do. I'm going to start with the regression beta, 1.24. It's a median. I'm going to use a median debt to equity. Again, I'm using median, not because of some financial reason, purely for a statistical reason. And I'm going to unlever the beta, just like I did for Disney. I end up with an unlevered beta of 1.03. For movie company. I'm almost home. I can smell the finish line. I can see the. You can't smell the finish line, I guess. I guess you could. Depends on what's on the finish line. But I mean, I'd go off on a tangent. So basically, that is the unlevered beta of being a movie company. Final piece. See this 2.96%? The typical movie company is about 3% cash, 97% movies. The unlevered beta 1.03 reflects the whole company. But I want only the 97% that's movies. So last step, I divide the 1.03 by 0.97, the 97. I end up with a levered beta, or an unlevered beta, just for being in the, this is called a pure play beta of 1.1. So let me go through the steps.
What is 97?
Sorry?
What was point?
It's 1 minus the cash. So basically, it's whatever's not cash is movies. So it's 3% cash, 97% movies, and I'm trying to look at just the beta of the movie business. So let's go through the steps. You're in a business, I find publicly traded companies in that space. More the better. I take an average of those regression betas for those companies, or a median if you find the average is strange. I end up with a levered beta of being in this business. Then I look up the debt to equity ratio of companies in this business to clean up for the effect of debt. I end up with an unlevered beta for companies in this space. Then I look to see how much cash companies typically carry in this space to come up with an unlevered beta for being just in the movie business. Yes? Question? No. That's basically how I get the unlevered beta. See this last column? That's basically what I repeat with each sector. Look, yeah?
Struggling with the fact that you take out the cash, because cash is a part of your business.
Is it?
You use it.
Do you? Let's say Apple. 200 billion cash. Where exactly are they going to use the 200 billion in cash? There might be a very small sliver of cash that you use. I would wager that in most companies, the cash you use is an incredibly small subset of the cash you have. You know, collectively, US companies have $2 trillion in cash on their balance sheet right now. Google has 80 billion. Apple has 200 billion. GM is half cash as a company now. The value of its auto business is roughly equal to the value of the cash. There is no way that that cash is needed for your operations. We can debate why the cash builds up. So what I'm saying is when you look at the beta for Apple as a company, The fact that 1/4 of the companies is in cash is going to make the beta look abnormally low, lower than it should. If you're trying to get a beta for just the business they're in. So what I'm saying is, let me take out the effect of beta, because I want to get a beta for just the business you're in. In this case, it's not a big deal. It's only 3% cash. But in some of these businesses, you can see that, for instance, in the gaming business, because a lot of technology companies accumulate a lot of cash, the typical gaming company is 17% cash, 83% gaming. Yeah.
Simply remove the cash from the debt.
You could. That's the other choice. Is in Europe and Latin America, you use what's called a net debt ratio. You get exactly the same effect. And if you prefer to do that, that's fine. I prefer to separate out the debt effect from the cash effect. But you can net the two out and use a net debt ratio. You will have effectively the same answer. So I end up with the betas of the 5 businesses you're in. What's the next step? To get a beta for Disney, I need to know how much value you get from each of the 5 businesses, right? So what I did, and this is actually kind of a breakdown of how this looks from a balance sheet perspective. So if you're confused about what I did, go back and look at this page. It'll confuse you even more. But basically, it tells you the kind of sequence of steps I took to get from a regression beta that's a levered beta to the unlevered beta of the business you're in. So now comes the step where I want to get the value for the 5 businesses. What did Disney give me though? They gave me the revenues for each of the 5 businesses, right? If I'm lazy, what can I do? I can just take a weighted average based on revenues. But the reason that's lazy is then I'm assuming $1 in revenues in the theme park business and $1 in revenues from the movie business deliver the same value. Is that true? If any of you work at multi-business companies and you have 5 businesses with revenues from each, are they equivalent? What causes them to be different? Some businesses you make 20% margins, other businesses you make 3% margins, right? In some businesses you have high growth, others you don't. So if you use revenues, recognize it comes with that limitation. It might not quite capture the effect of that. Question?
Actually, that was the question I was going to ask. Line of business, operating subsidiary, concern versus standalone operation.
Exactly, and that's the concern. So this is where I paused and said, well, I'd like to estimate the value of each of these 5 businesses rather than take your revenues. And I cheated. If you go back to this page, if you take the market value of equity, add debt and subtract out cash, you get what's called enterprise value. Analysts use this word all the time. But basically, the way to think about the enterprise value of a company, it's a measure of how much the market is valuing your operating assets at. That's what an enterprise value is. For each of the publicly traded companies in the movie space, I took the enterprise value that I got from the market and divided by the revenues that each of these companies got to get a ratio. So you say, what do I do with that ratio? Across movie companies, that ratio is 3.05. Let's make it rounded down to 3. You say, what does that even mean? If I look at how other movie companies are being priced, for every $1 in revenues, you get $3 in value for being a movie company. I did this for each of the 5 businesses. So what you see in this page is actually the revenues that Disney tells me that each business has, what companies in this business trade at as a multiple of revenue. So let's take the movie business. What does Disney say their revenues are? About $6 billion. You multiply $6 billion by 3.05. That's the ratio I got by looking at other movie companies. The value that I get for the movie business is $18.3 billion.
From where we got this?
Same place we got the betas.
By sales.
So we're looking across the companies, right? So I have the EV for each company. I have the sales for each company. You divide the EV by the sales. So the same companies I'm using for my betas, I'm also looking to see what the market is pricing these companies at. Now, why are some businesses going to give you a higher multiple of revenues than others? Because they have higher margins and higher growth. What I'm trusting the market to do here then is give me a number that will reflect the value of the business rather than just trusting the revenues. And I do this for each of my 5 businesses. You can see, in the consumer product business, for every $1 in revenues, I get only 83 cents in value. Do I like it? Hey, it's not for me to like or dislike. It's what the market is paying. And in fact, if I take the pieces that I valued and add them all up, I get a value of $135.1 billion for Disney as a business.
Have you ever heard of the sum of the parts valuation? Analysts will often talk about doing a sum of the parts valuation. It sounds like they're doing something really fancy. They're not. This is actually a sum of the parts valuation right there. That's all analysts are doing, is they take the businesses, they're taking revenues or EBITDA or some measure of operations for each business, applying a multiple to it, and it's a back of the envelope valuation. But essentially it gives me a structure that allows me to break Disney down. And as I see Disney in 2013, this is what I see as a company. Disney is about 49% broadcasting, about 33.8% or 34% theme parks, about 13.5% movies, about 2% consumer products, and 1.5% gaming. Of course, the weights all have to add up to 100%. Okay. The biggest part of the broadcasting business at 49% is, of course, ESPN. Now you say, what about Star Wars? If I did this in 2016, the movie part might have gone up from 13.5% to about 20%. So you're going to get these moves around. But I'm basically breaking Disney down into 5 businesses. Those are the weights that I multiply by the unlevered beta for each business. And what I get is an unlevered beta for Disney as an operating company is that weight times, so you take the weight and you multiply by each of these numbers. The sum of those weighted numbers is 0.92. That is my unlevered beta for Disney's operating business. Now you can bring in whatever you want. You can say, well, Disney has a lot of cash. Not a problem. If you ask me what the beta for Disney is with the cash, all I need to do is take the 0.9239, weighted by the operating businesses, and cash, of course, in the US, because it's invested in T-bills and commercial paper, something riskless, has a beta of 0 times however much cash you have. So essentially, the process allows you to build up to a beta for a company by looking at what business it's in and bringing in whatever you want about the company. The fact that there's cash, no cash, lots of cash, it gives you the flexibility of dealing with almost any aspect of the company. Yes, John?
Can I just ask, the implicit assumption in this is that we break the company down.
Right.
One doesn't need any debt or any cash to generate the sales, the revenues, and the earnings.
That's not necessary. But I'm just using the sales to get a value. I'm still going to bring in debt as a final piece of the puzzle. The cash, you're right. I'm essentially saying there's not enough of a operating cash requirement in each business where I have to do it. If there were, all I would need is one extra column where I put in the operating cash in each business and take it out of the business value. Right? But the debt I'm going to bring in separately, because debt you might need. I'm being agnostic about it at this stage in the process. But at the last stage, when you talk about levered betas, I can no longer be agnostic because now I have to look at how you funded these businesses. So last stage, what do I need? I have an unlevered beta for the company. I have the unlevered beta for the 5 businesses. I try to estimate how much each of these businesses carried as debt.
Yeah. Let's just ask a question. On the previous slide, you showed the value of 135 billion.
135 billion.
In terms of valuation, would that also be?
That's a good question. If the market is, let's say the market value of Disney is only 120 billion. And you've added up the 5 businesses and come up with 135 billion. And you trust your 135 billion. What are you going to do next? Buy Disney, but be very careful what you will, because it might be 120 billion because it's being run as one consolidated company. But if you're an activist investor, what did the people targeting Sony wanted to do? They want to break it up. Okay, so if you feel that the value of the pieces is greater than the value that you see for the company, this becomes your impetus for trying to break it. This is why GE is doing what it's not doing it out of the goodness of its heart or because it came to its senses. The pressure from below. GE is actually being targeted by activist investors precisely for this reason. They feel that the 26 businesses GE is in, if valued as separate businesses, would be worth a lot more than what you see for GE as one composite company. I mean, we call it the conglomerate discount. There's all this legend that goes around it. But that's effectively how to read that sum as opposed to the total market value. Yes?
I worked for GE for 10 years, and the capital business is making value at 0. So whatever they say, $1, I want more EV than the actual market.
Internally, they're valued at 0. Is that what you're saying?
Outside market, when they look at the way
No, that.
the valuation of
Yeah. Which is, you're saying the same thing. It's not that it's valued at 0. The composite company was valued much lower than its pieces. And to me, it's always been a puzzle why GE did not start doing this earlier. You seem to go from company to company which has these issues, right? You went from GE to Groupon. So maybe you're the canary. Maybe you're the canary in the coal mine kind of thing. Watch where he goes. The change is coming. So if you can get Groupon to fix its ways, that'll be good too. So I'm not blaming you. Right? Yeah. So I have the unlevered beta for the pieces. Last piece, I need to know how much debt each business has. So I started looking through the annual report of Disney. You know what I was looking for? Is whether they could tell me which businesses borrowed money and which did not. I'd like to know where the debt is. What they gave me was a composite debt. The composite debt at Disney was about $16 billion. But they didn't tell me where it was. I had to make some judgments. And here's how I allocated the debt across the businesses. If you go back a few pages, they told me what they called were the identifiable assets. I don't even know what goes in there. But they broke their assets down by business. I made the assumption that the debt is allocated in roughly the same proportion. Yeah.
Why is that necessary? Couldn't you do the
comparable debt to
leveraging after everything else? Kind of do it as a last step.
This is my last step.
But why do you need to weigh it?
Because I want a levered beta by business. It's not just enough for the whole company. I want one for each business.
If I take Roman's tax lawyer argument, I would say the debt decision is a corporate decision, not a business.
So which is different. You're saying why not give them all the same debt to equity? Because then you're going to be giving the movie business. In fact, in my first 2 editions of the book, that's exactly what I did. And I used exactly the same argument that you did. But intuitively, I was fighting with myself because here's what I know. I know the theme park business borrows a lot more money than the movie business.
Because you can get a mortgage.
No, because it's infrastructure, it's land, it's building, right? So when you use that, there is that cost. In some cases, for Vale, I use the same debt to equity ratio for all the businesses. Here, because the businesses are so different, like the cruise lines, I guarantee you they're borrowing money to buy those cruise ships. So I wanted to make my best try at allocating the debt. And that's basically what this is. It's just my judgment. That basically leads me to very different debt to equity ratios by business, ranging from 10% for the broadcasting business to 117% for the consumer product business. But remember, it's a licensing business. The income is pretty much a steady stream. They can afford to borrow a lot of money. That debt to equity ratio was what I used to take my unlevered beta for each business to a levered beta. So I know it's lots of steps on top of each other. I started with Disney as a company. I looked at the 5 businesses they were in, or they told me what 5 businesses they were in. I went and found publicly traded companies in each space, stretching my definition of comparable. Then I came up with a levered beta, which I used to come up with a beta for each business. Then I used this revenue and enterprise value to sales ratio to come up with a value for each business. I came up with a weighted average, an unlevered beta for the company. Last step, now I have a levered beta for each of the 5 businesses and a levered beta for Disney as a company. My levered beta is what? See, this is a lot of work. Why don't you just use one from... I didn't know I was going to end up at 1. As opposed to what did my regression beta come back with? 1.25. And what I'm saying is when the numbers are different, I'm going to go with the bottom-up beta because I trust it more. It's more precise, it comes from the bottom up, it reflects the businesses there. And here's the bonus you get. What do we use this beta for? To get a cost of equity, right? I now can give you a cost of equity for Disney as a company and for each of its 5 businesses. There's nothing else you take out of this class. This next page, I hope, is one you will remember. Here's why this is useful. I have a cost of equity for each of the 5 businesses. Let's play a game. Let's assume that I'm the CFO of Disney and you're the movie guy. You run the movie business. So my job is to say no to you because you come up with all these outlandish ideas. So you've come up with a new project. Let's call it Lone Ranger 2. This time we're not using Depp. So you walk in my office, we have this big budget movie we'd like to make. And I get ready to throw you out right after you say Lone Ranger 2. You said, this time we've looked at the numbers. It tells me a little bit about last time, but let's not go there. We've got these 3 MBAs who come in and ground out the numbers, and we think we can make a return on equity of 9.5% on this movie. No movie guy ever talks like this, but act like you do. So you think you can make 9.5% and you want me to fund the movie. See why I picked 9.5%? Go back to the previous page. 9.5% is higher than the cost of equity for Disney as a company, right? That's good. But it's lower than the cost of equity for the movie business. So basic, fundamental question, this is Corporate Finance 101, is when I look at investing in this movie, should I use the cost of equity for the company that's going to come up with the money to take the movie, or should I use the cost of equity of the business? The project. It should be the business. You know how many times every day this principle gets violated? With all kinds of stupid reasons and not so stupid reasons. If you're a multi-business company, you have to have hurdle rates that vary across businesses. Right? If you have risky businesses, you should have a much higher hurdle rate than if you have safe businesses. The cost of equity for a project should not reflect the entity taking the project, the risk of the business the project is in. In fact, let's do a little what if. What if I decided to do what half of all companies globally do? Multi-business companies use one cost of equity across the board. So I'm going to use 8.52% as my cost of equity in all 5 businesses. Which of my businesses is going to be absolutely delighted at what I'm doing, and which ones are going to be really pissed off? All the risky businesses will say, this is wonderful, I'm glad to be part of the Disney family. And the safe businesses are going to be really pissed off and carry that through. Over the next 5 years, what's going to happen? The risky businesses are going to overinvest. You see why overinvest? They're taking projects that are being subsidized by your safe businesses. You're saying that's okay. But what's going to happen over time to your safe businesses? They're going to shrink and disappear. It's almost inexorable that multi-business companies that use one cost of equity across time are going to get riskier and riskier and riskier because the safe businesses are going to... So, if it's so obvious that we need to have business-specific cost of equity, why is it that so many companies stay stuck with one cost of equity? Well, in fact, they're misallocating. In fact, it's precisely because you want to allocate capital that you want to make sure that the cost of equity is vary across business, because otherwise you're over-allocating capital to risky business and under-allocating to safe businesses. Where do most people get their cost of, where do most people get betas? Bloomberg page, right? You see already how you're going to get into trap. You have GE. You get a beta for GE. You don't get a beta for GE Capital. So the first problem is the way you get betas comes from a regression. You're going to get one beta for the whole company. You're not. So the first problem you're going to run is mechanical. I'm able to do this because I'm building from the bottom up. You know the second reason companies hate doing this? The minute you bring up this prospect of different hurdle rates for different companies, all heck breaks loose. I'll give you an example. About 20 years ago, a little more than that, 1992, a student of mine went to work for the Gap. This was when Gap was a growing retail company. It was on the verge of expanding. Until 92, Gap had been historically just one type of store, another mall store, another Gap. They were all Gap stores. And they used a hurdle rate of 18% in every single store. Where did the 18% come from? Here when I got here was probably the answer. Nobody had any idea, but it was used over and over again. And in 92, actually, the Gap started widening its base. It introduced 2 new chains. One was called Banana Republic and the other was called Old Navy. So this guy joined just at the cusp of this change. So he calls me all excited about these new businesses. And he describes them to me. And if you've ever been in Banana Republic, it's really Gap clothes marked up 30%, but you don't have to deal with the riffraff. And Old Navy is basically kind of a discounted. So as he described these, he said that, and so we both talked about it. And we talked about what kind of hurdle rates they should be using. So help me out here. You got Banana Republic, Gap, and Old Navy. Think just purely in terms of intuition, what we went through. Remember the 18% hurdle rate? If you're going to have different hurdle rates in the 3 businesses, which of these should have the highest hurdle rate? Republic. Then you should have, Gap and then you should have Old Navy. So we talked through this and he said, that makes sense. I'm going to bring it up at the divisional head meeting next week. I knew exactly what he was walking into. But I didn't want to let him in on what was going to happen. He said, call me after it's done. He called me, forlorn. He said, it did not go well. I said, what happened? He said, when we brought up this idea of having different hurdle rates by business, one of the business heads didn't like the idea at all. I said, let me guess, was it the Banana Republic guy? He said, yeah, he hated the idea. CEO of the Gap then was a guy called Mickey Drexler, merchandising legend, if you know. So I said, what did Mickey say? He said, no, Mickey really likes this Banana Republic division and the division head. He didn't want to rock the boat this year, so we decided let's just not deal with this right now. Pushed it off. That's the other issue, is this is a fight you have to be willing to fight as a multi-business company. Because the risky businesses are all going to claim that this is unfair. You know what? Banks have have put this off too long. And in fact, part of the problem at banks is they've allowed the risky businesses to get away doing stuff subsidized by safe businesses because they want to confront us. John?
I mean, I couldn't agree with you more. It's a fabulous piece of work. And just to compound on that, linked to banks, HSBC bought Household in the US, which was exactly what happened here in terms of thinking about risk and cost of capital. But it also happens in the broader world too. And if you think about what happened in the Eurozone, and we put a German credit rating on the Greek economy, it's broadly the same thing.
Yeah. Exactly, it's subsidies, right? Anytime you let safe businesses, countries, parts subsidize, you're going to get all kinds of bad decision making that 10 years later you're going to say, what the heck were you doing? They did exactly what you subsidized them to do. And now it's a first thing. When I go to multi-business companies, the first question I ask them is, do you actually use the same hurdle rate across your business? And the answer they give is yes. Then I say, our work is laid out for us. This is common sense. We've got to start thinking about risks of different businesses. Yeah.
I'm not sure I completely buy into that. Because one organization many times supports another division of the organization, like the movie business will support the merchandising.
Okay, let's pause there. When you say support, what exactly do you mean?
So merchandising isn't going to go so well if there isn't another hit.
Okay, now we're talking. You're saying, look, the returns I make on a movie might not reflect so you're actually making a different argument. You're saying the 9.5% is understated because my theme parks are going to benefit a star. You know what I'm going to ask you to do then? Not change. The principle I have will still apply. I'm going to say, look, go in and bring in the merchandising revenues and the theme park revenues the movies are going to take. Let's recompute this 9.5% to include it. And guess what? If it still doesn't beat the 9.95%, then we still have a problem, right? The reason I would force you to do it is good for you and good for me. It's good for you because now you have a plan, right? And let's face it, a Star Wars, the movie is just the first piece of the puzzle, merchandising it. But if you're talking about an Avengers movie, if the movie doesn't pull in enough in the box office, so it forces you to think about different, and so a Marvel movie and a Star Wars movie might deliver different returns. So I agree with you, there's this other stuff. But that other stuff, I wanted that return. And I still want you to beat the 9.92% cost of equity. Yes?
Just a small point. As many full acquisition of the GE, and the way it worked is that with the Guarantee Bank, the second level bank,
right.
It was raised at 13% on the balance sheet, and we switched it to GE at 2%. So at day one, we returned the full balance sheet, and then you did the tax. You get the fast the money from tax deduction. So at day one, you can refund the balance sheet of the full bank, and you can.
I'm going to tell you a story about GE that kind of cuts to the heart of a multi-business company and how it gets into the messes that it does. So about 10 years ago, I was in Stamford, Connecticut, the GE headquarters, and they asked me to speak to the divisional heads about acquisitions. GE is a company that's going through acquisition. Is an acquisition like a new project? So if you apply the principle that I've just applied, when I compute the cost of equity for a target company in an acquisition, you know what I should be using, right? It should reflect the risk of the target company, not
the cost of equity for GE. So I go through this process of Corporate Finance 101. I hope when you're valuing target companies, you're using the target company's risk and its cost of equity to value these target companies. And I look around the room and there are all these sheepish looks on the faces of divisionals. I said, you could do this at GE, right? You're pretty sophisticated. And one of the divisional heads says very sheepishly, he says, well, at GE, we're so large and they're so small, we don't think it matters that much. I said, really? So corporate finance principles don't matter if you're big and you're buying small. So in fact, I said, I'll be back in a few weeks. In fact, I was back. The next time I came with a prop. 2 props, actually. I bought 2 Krispy Kreme donuts. Have you ever seen these? These are things that will kill you when you even look at them. It's like 1,500 calories. It's double fried, triple fried, lots of sugar, like 6. So I brought, and one of the donuts I cut into 24 small pieces. And the other I left as one donut. And I said, does anybody here like donuts? And 2 people in the front put up their hands. I gave one guy the full donut, the other guy 24 small pieces. I let them eat the donut. 2 donuts. Then I asked the first guy, how many calories do you think you just ate? He said, like 300. I said, you underestimated by like factor of 2/3. You actually ate 900. And I said, second guy, how many calories did you just eat? No, he ate it in 24 small pieces, right? It should be less calories. Turns out that you eat a donut in 24 small pieces, you're still eating a donut. See what this has to do with acquisitions? You have small acquisitions and you screw up the same way on all of them. At the end of the process, guess what? It's like screwing up on a big acquisition. This rationale of we're so big and they're so small doesn't justify breaking this rule. Okay? So if when you go back to your desk, which should be very soon, right? Like Monday, start looking around, because this, I think, is something we have. Because if you think about it, it's not just now businesses. You take GE, they're in 26 businesses. They're in 72 countries. So if they ask me what the hurdle rate for GE is, I don't know. For what? An aircraft investment in India? Well, I can tell you now, because I know what business you're in, what country. But I can't give out a hurdle rate to a company which is a multi-business, multinational, and expect that hurdle rate to travel all over the place. It doesn't make sense. So the bottom-up beta to me is not just a way of getting around the regression beta problem. It forces me to think about the businesses here and attach numbers to those businesses. So I decided to do this to my other business as well. And here things got a little easier. I took Vale. Vale is in 4 different businesses, was in 4 businesses, because one of these businesses, the logistics business, they just sold off. So 4 businesses: metals and mining, iron ore, fertilizers, and logistics. I did exactly what I did for Disney. I went in front of publicly traded companies and look at the size of my sample. With fertilizers, I have 693. I can be incredibly sloppy about the way I estimate individual betas, because the law of large numbers is just bailing me out at every single step. That's why I use global averages. I can be sloppy then about indices you use, returns, how you compute the returns. I come up with an unlevered beta by business, and based on my breakdown, the unlevered beta for Vale as a company is 0.844. It's the unlevered beta. Vale's debt to equity ratio is 55% in 2013. It's now like 150%. Now you can work out what the effective beta is going to be. Here I attached the same debt to equity for all the businesses. It wasn't worth the effort of allocating the debt. And I got a levered beta and a cost of equity by business. Not a huge variation here, because the businesses are not that different. Now, one interesting trick you can play is, this is actually an issue that came up yesterday, that we have dollar spreads and dollar premiums and we're mixing them in with real stuff. It's a mess. And I agree. If you want a clean cost of equity in a local currency, here's what I suggest you do. Do everything in US dollars first, or euros. Pick some base currency where things are. So I use US dollars because all my risk premiums in US dollars. Come up with the cost of equity in US dollars. For Vale, the cost of equity in US dollars was 11.23%.
There's no regression beta.
There's no regression beta. It's about, see, that's the advantage, because then you say, did I use a beta against, I know what you're going to ask, against the S&P 500. Who cares? They're all crappy anyway, right? So what does it matter what that is?
So I have a cost of equity of 11.23% in US dollars. What did I say the only reason currency matters was? They bring in different inflation. So if you today said, look, I don't want to do anything in dollars, I'd like to do everything in nominal reais, I'm one step away from giving you a nominal real cost of equity. And all I need are two numbers. One is the expected inflation in US dollars. And that's actually easy to get. You know where I'd get it? Take the T-bond rate, subtract out the TIPS rate. TIPS rate we said was the real interest rate. Right now it's about 1.5%. So that's the expected inflation. Give me the expected inflation in Brazil. And that's a little messier because you will give me last year's number, right? Because often that's what you have. You can give me some expectations, but let's say it's 9.5%. And this is where we can get disagreements. Let's say it's 9.5%.
Now we have the Brazilian inflation bonds up to 2035.
And that's, so get that expected inflation. You're home free. Do you see why you're home free? Because here's a simple way to do it. Take the difference, 9 and 9, in this case, 9 and 2 was what I used here. 9 and 2, 7%. Add that on if you're in a hurry to your US dollar number. You've got a nominal real cost of equity. It's actually, because the numbers are so high, my suggestion is you do it right, which is a compounding effect. When you do the compounding effect, I have a nominal real cost of equity of 18.87%. Just to contrast, what did I've got if I build off a nominal real risk-free rate? Is that I've ended up with a slightly lower number because of the mismatch that I've used of a dollar. Really, the 18.87 is a better estimate than the 18.67, but you can see why I'm okay with using a nominal real risk-free rate. The numbers are not going to be that different. So it's a very simple way you can move across currencies.
What the system we used yesterday,
right.
I mean,
the system I used yesterday was down here.
Yeah, so basically we can stick to that.
Why are you so stuck on sticking to a system? Are you talking about the quiz tomorrow? Let's separate out. I agree with you on the quiz. You're saying what is the right answer. Remember, I grade the quiz. So I'm not going to penalize you for trying to do the right thing. So if you use this, so to me it doesn't matter. If you're asking me what should I do on my desk, what does it matter which system I would use? You'd have to pick whatever you're comfortable with. In this case, it doesn't make a big difference because what you're getting is a compounding effect. That's basically what it is. If you feel that one system is easier to use and you won't come, just stick with it because you built in all the first principles into it. Now we're talking at the margin. Is it better to use 18.87 or 18.67? Not a big deal, right? Completing the process for Tata Motors and Baidu. For Tata Motors, I looked at publicly traded automobile companies, but I did use the debt to equity ratio for Tata Motors and the tax rate for Tata Motors. So the unlevered beta came from looking at automobile companies globally. And I know part of you is already saying, but it's an Indian automobile company. You know my reaction to that is? I can punish it for being an Indian company where? My equity risk. Don't let betas be the instruments for punishing companies for risk. It was not designed for that. So the risk-free rate is a rupee risk-free rate. The beta is an automobile beta. The equity risk premium reflects where you operate. So my cost of equity of 14.49% is now going to be my rupee cost of equity going forward. For Baidu, I started with the unlevered beta for online advertising companies, and there were 42. So this includes companies like Google and Facebook, and I'm okay with that. The 1.30 adjusted for the debt to equity of Baidu and the tax rate in China gives me a levered beta. And if I do everything in Chinese renminbi, risk-free rate is 3.5%, beta is 1.356, the 6.94% is a weighted average, in this case only China, so it's just China's equity risk premium, cost of equity of 12.91%. So in a sense, I want you to kind of get comfortable with this process. You know what each number is carrying, so it's not piling on more stuff into it. You're not double counting or miscounting something because everything has a place. Which brought me to Deutsche. So remind me again how I got Disney's bottom-up beta. I broke it down to businesses. I got the unlevered beta for each business. Then I got the debt to equity ratio for Disney to get a levered beta. Yeah.
Can I ask a question?
Yeah.
When you are computing the regression for all the original betas,
yeah,
and then you're going to leverage it order, do you always use the S&P 500 even if it's a no company?
I'll tell you the practical problem I face. How many companies do I have in my sample?
41,889, right? If I ran the regression for each one, even if it's just the Bloomberg beta page, and I start on January 1st, 41,889 regression betas later, the year's probably going to be over. So I have to take a service beta, which means I have to use whatever beta process the service uses. The long answer to the question is S&P Capital IQ, which is what I use as my raw data source for my betas, uses the S&P 500 for US companies, uses an emerging market equity index for emerging markets, and the local European indices for European stocks.
Right, but in our case, if we don't have this S&P, what should we do?
Use Yahoo Finance. Free betas. Yahoo Finance reports betas by company. Google Finance.
Website too.
Oh, you can use my website. No. Yeah, so it's, and so there are lots of different places. So don't do betas from scratch. It's just too much work to run the regression yourself. So you're looking for a service, and to me, which service is better? It doesn't matter. The larger your sample, the more sloppy you can become. Right? But here's the thing: that banks that is going to give me trouble. What do I need to unlever a company's beta? A debt to equity ratio, right? Have you ever figured out the debt to equity? Try this out. Take any bank. Tell me what its debt to equity ratio is. About 6 weeks into the process, you're going to give up. And there's a simple reason. Debt to a bank is not a source of capital. I said this yesterday as well. It's raw material. It's like steel to an automobile company. So when we talk about banks, levering and unlevering becomes almost an impossible concept to apply. So you know what I'm going to do with Deutsche Bank, right? I broke it down to two businesses, commercial banking and investment banking. I found publicly traded companies just like I did for Disney. I came up with the average levered beta for those comparable companies. And then I just used it. See the step I skipped? I'd unlever them and relever them because I have no idea how to even do it. Are there dangers here? Yes. I'm assuming that every commercial bank has roughly the same beta. The problem with that is not only your underlying businesses more risky in some cases, but you also have this regulatory capital risk overlay, right? You know what I mean by that? A lightly capitalized bank is in a sense more risky than a heavily capitalized bank. So what I'm actually working on right now is a way of coming up with betas for banks that looks at your regulatory capital ratio and the kind of businesses you're in. Because I agree with you, this is a process where I'm lumping all banks together, and that might be an extremely dangerous thing to do post-2008 because we've discovered banks can find risks in ways that we didn't even think was possible. So the beta that I get for the investment banking business is much higher than the beta that I get for commercial banking. And the same principle applies. If you're a bank and you're in trading and private equity and investment banking, you better have different hurdle rates across the bank. Otherwise, you're going to create damage right and left as you start investing because you're going to be subsidizing risky businesses with safe businesses. This is the core of the Volcker rule, right? I mean, you either agree with it or disagree with it. What the Volcker rule essentially says is, not only are you subsidizing risky businesses with safe businesses, you're using depositor capital to enter risky businesses. And that's, I think, at the core of the debate. So let's take our lunch break. When we come back, we'll talk about betas for private and closely held companies.